I want to introduce Shawn Yesner with Yesner Law. Shawn, welcome to the show.
Thank you for having me. I appreciate being here.
I've known Shawn for a long time. We happen to be, I'll call business neighbors. We work in the same business complex. Our offices are very close. Shawn, tell me a little bit about you. Tell me a little bit about your background. I know you're a native Tampa guy, born and raised in the area. Tell me a little bit about Shawn Yesner and what got you into real estate law.
Yeah, it's an interesting story. So I am a Florida native and spent all of my life here in Florida except when I was in law school. And it's interesting. I was thinking about this the other day. 25 years ago, 1990, I was a freshman in college. 20 years ago, in 1995, I was a first-year law student. So I went to college in Tallahassee, went to Florida State, graduated from Florida State with an accounting degree. So
we won't hold that against you.
I either got you, twice the audience, or I cut away half your audience, one of the two. So I went to Florida State undergrad, went from there to Cumberland School of Law, which is part of Samford University up in Birmingham, Alabama.
Yeah.
And so I went to Birmingham for 3 years, spent 3 years in Alabama. After that was over, you can take the boy out of Florida. You can't take the Florida out of the boy. So came back down to Florida, started my career in Miami doing residential and commercial closings. An attorney, an associate attorney, working at a small boutique firm, did residential and commercial closings, and I loved it. I loved every aspect. It was one of those areas of law, at least at that time, the late 90s, early 2000s. Mm-hmm. It was that type of law that everybody walked away happy.
Yeah.
The buyers got this house that was either brand new or new to them. Sellers walked away with a big fat check.
It's great, right?
Everybody walked away happy. And I really took to it. My background, my accounting degree from FSU, my numbers background, I took to every aspect of it. Absolutely loved it. But I knew one day that I would be my own business owner. And I didn't have those opportunities, or didn't think I was going to have those opportunities. I actually grew up in Miami. It wasn't really the same place in the late 90s, early 2000s that it was in the 70s, 80s, and 90s when I was growing up.
No doubt.
And I knew I didn't want to be there forever. And so I found a job up here in Clearwater, actually, at what we would call today a foreclosure mill. So we represented lenders. We were, I guess, depending on the audience, the good guys or the bad guys, depending on whether they're, borrowers, lenders, Knowles, Canes, Gators, whatever.
Didn't matter. And that was before we even saw the housing bubble burst that we experienced years after that. So.
Right. This was from 2001, and I left there in 2004. So the market was, a good month for us was 800 foreclosure referrals across the state.
Okay, that's the whole state of Florida.
The whole state of Florida.
Okay.
We got 800 referrals. That was a banner month for us. Average month for us was probably about 400 to 600 referrals. And we represented all the big ones. We represented Freddie Mac. We represented Chase. We represented the VA. We represented, at the time, Washington Mutual, Green Tree, all the big subprime guys, the Fairbanks, which is now Select Portfolio Servicing, SLS. Back then wasn't called SLS, was called something else. Represented all of those guys. And as much as I enjoyed the real estate law, I found the foreclosure aspect of it just as fascinating. One of the things that I really got a good education on being on the plaintiff side of it was every aspect of the foreclosure case itself. So all the foreclosure mills that exist today tout themselves as cradle to grave or soup to nuts or start to finish, whatever. Meaning as soon as that file comes into their office, they work that file until it's over, whether it's over because they got a foreclosure judgment at hearing or a foreclosure judgment at trial or bankruptcy, or they got the house back, or it got settled with a loan modification or a short sale, or whatever. That firm handled that case from start to finish. They can do everything for the lender, evictions, titles, everything. All the firms advertise themselves to the lenders in that way, including the firm I was at. The difference is the firms today, the attorneys are broken up by department. So you'll have one group of attorneys that does the drafting of the lawsuit. Then you'll have another group of attorneys that argues at the hearing. Then you'll have another group of attorneys that goes into bankruptcy court. You'll have another group of attorneys that does the evictions, and so on and so on and so on. The firm that I was at here in Clearwater, the attorneys were also soup to nuts, cradle to grave, what have you. The paralegals, the legal assistants were broken up by department. But what that meant is at any given point in time, I had a stack of files where I needed to make sure we drafted the complaint properly.
Right.
I had a stack of files that I needed to make sure we're ready for hearing. I had a stack of files that I had to go to bankruptcy court. I had a stack of files that I had to do evictions. I had a stack of REOs. And so I really got exposure to the entire process from start to finish.
Right, right.
In 2004, the owner of the firm said, I don't want to do this anymore. Now, that firm still exists. It's now the owner of the firm is a very well-respected, very knowledgeable intellectual property attorney, so patents and trademarks and copyrights and that kind of stuff. And that's what she enjoyed doing, and she's still doing that to this day. But in 2004, when she shut the firm down, I saw either move laterally to another foreclosure mill, or maybe this is the kick in the butt I need to hang my own shingle and start my own firm. So I did. Now, I knew at that time Freddie Mac was not going to hire me. Chase was not going to hire me. The VA wasn't going to look at me. So I switched sides, and I started defending homeowners who found themselves in foreclosure. Still with the focus on real estate law, I still did closings and all that stuff. And ended up, that's when the market really started to take off, and then we had the crash. And so I've been doing foreclosure and loss mitigation and foreclosure-related real estate law long before it was popular to do so by other attorneys.
Right. So you got an opportunity really to see it from both sides, which probably a lot of attorneys have never seen it from that extensive of a process, before the bubble burst, right? So you were working in kind of a real-world environment as opposed to this uber foreclosure, uber bankruptcy environment that we're in today. You got to see it from the plaintiff side, so you know what they deal with. Now you can go defend that foreclosure or short sale or whatever the case may be, and you've got the understanding from A to Z.
Right.
You've been there. You've done that.
Yeah, I got to practice it at a time when the plaintiff's attorneys, the bank's attorneys, were actually counselors and advisors and gave legal opinions. And so the lender would call me up and say, hey, I got this issue from the defendant, or you pointed out this issue from the defendant. What do you think we should do, Florida counsel? Right. Where today, that from talking to my counterparts that are still doing it from the plaintiff side, that doesn't happen anymore. Right. The plaintiff's firms, by and large, that are here in Florida are really just hired guns.
The volume that they're doing has got to be, it's incredible, the amount of volume. That's why a lot of times you see a foreclosure could take, I've seen them take up to 5 years. Yeah. The foreclosure, process, the courts are just bogged down. The courts are bogged down. The plaintiff's attorneys are bogged down. Even at my height when I was working plaintiff files, I probably had an active caseload somewhere in the range of 600 to 700 pending cases at any one time. That doesn't mean I was in court 600 to 700 times, and a lot of the paralegals and systems and whatnot supported all of that. But today it's double that? Yeah. So that's crazy. What it also did is gave me a perspective on I'm not going to defend the foreclosure just for sake of defending the foreclosure. I'm not going to defend the foreclosure to pat myself on the back as a bank killer. I liked what you said at the beginning in terms of something that I also try to do. I want, when the client sits down with me, if they have a foreclosure-related issue, I want to give them 4, 5, 6, 8, 10 options of we can do or we can do a short sale, we can do a loan mod, we can do a bankruptcy, we can maybe salvage the house, maybe there's equity, we can sell it, maybe the bank did make a mistake. I've had a handful of those cases where the bank legitimately, I'm not talking about robo-signing, right. I'm not talking about any of that stuff. The bank legitimately made a mistake, and so let's defend the foreclosure on those grounds. But at least to give the client all of those options, and then let's figure out. I have people come to me all the time and say, well, I want to do a loan mod. Well, that's great, but if your plan is to leave the house in the next, your kids are getting ready to graduate and go to FSU, and they're going to be out of the house, and you maybe want to downsize in 2 to 3 years, well, you're going to be a short sale then. Right. So why not just short sell it now and be done with it? Yeah. Well, let's talk about that a little bit. Let's get into some specifics. We talked a little bit about some of the basics. Let's talk about, that's I think a great topic. You've got the option to maybe do a loan modification. you could tell us a little bit about exactly what that is,
right?
Or a short sale. So give us kind of what's a loan mod, what's a short sale, and maybe in that example why one would be better than the other.
The way that I look at it, a loan modification is exactly that. And one of my pet peeves, and I really don't ever call anybody out about this, but a lot of people say a loan remodification. It's a modification. If
right.
you're going to remodify it, that means you're modifying something that's been modified.
Right.
Just a pet peeve of mine. I really don't care one way or the other. But with a loan modification, you're changing the terms of the loan. You're modifying the terms of the loan. The way that I explain this to clients is the bank has a whole bunch of tools at their arsenal. They can re-amortize the loan. So they can say, okay, we're going to go today, we're going to go out 30 years, and what would the payment schedule be if we said, okay, the loan's current today, we're going to take what's due, add it to the principal balance, and we're going to re-amortize that, repay that over the next 30 years at such and such interest rate. That's one option.
Mm-hmm.
Bank could say, we're going to do that, but we're going to do it over 40 years, and we're going to cap it at 30 to make payments even lower. The bank can lower the interest rate. The bank can cut off principal balance and say, $10,000 gone. You don't owe it anymore. There's a whole bunch of options that the bank can do.
What do you see most?
Well,
from what I've seen, and I see people that come to me with loan modifications, to me, I think the more standard is a lowering of interest rate. That
right.
seems to be the probably go-to
right.
avenue for the banks.
What most banks do is they go by the HAMP guidelines,
right.
the Home Affordability Modification whatever process, and they say, we're going to look at your income, we're going to multiply that by 31%.
Yep.
We're going to then divide that by 12 so we get a monthly payment. We're then going to compare that to what you currently pay now. And then is there anything we can change in your current payments now to get them down to 31% of your income? The way that I explain it to clients is the bank has all these options available. It's not what can they do, it's what will they do.
All right.
And so that's where the HAMP analysis comes in. And so we look at 31%, divide that by 12 to get a monthly payment. So if 31% of your income is $12,000, and so you divide that by 12, $1,000 a month. If your mortgage payment is $2,000 a month, modification's not going to work. There's no number that the bank can change to bring a $2,000 payment down to a $1,000 payment. If your mortgage payment is $1,200, well, yeah, maybe there is some number they can change to knock $200 off the mortgage payment. But then we've got the other side of that. Your HAMP analysis payment is $1,000. Your regular mortgage payment is $600 or $700. Bank may not grant a loan modification because your payments would have to go up to do that. And even though a lot of people look at this and say, but that would still allow me to make the loan current and keep my house, the banks don't look at it that way. The banks say, I got to take a $700 and bring it down to $1,000, and that's never going to work.
Right.
And so they may not grant the loan modification in that instance. So that's a loan modification. A short sale is simply a situation where the sales price of the house is not going to cover what the owner needs to sell it. So you have a $150,000 mortgage, you sell your house for $100,000, there's a $50,000 deficit, that's a short sale. Or one thing we were talking about in preparation, you have a $150,000 mortgage and you get a contract to sell it for $150,000. Well, you're going to have to pay closing costs as the seller.
And typically real estate commissions.
Right. So do you as the seller have that money to bring to closing? If yes, not a short sale.
Right.
If you don't have the closing costs, then it's a short sale.
Right.
You're asking the lender to take less than what they're actually owed on the loan. The way that I analyze which one might be better, the first question I always ask is, client, what do you want to do?
Right.
What's
do you
your
want
goal?
to keep the house?
Right. Maybe they don't. Maybe they're involved in a divorce and they just want to break with those memories. Or maybe their spouse passed away in the house and they just want to break with those memories and get rid of the house. Maybe it's a situation where was never their dream house and they just don't want to keep it.
Right.
And maybe the reverse is true. Maybe this is their dream house and they want to do everything they can to save it. Or I got an email from a lady this morning who said that even modified or even without a modification, so even if we can't get the loan modified, her current payments are less than what she would have to pay in rent somewhere else.
Right. Yeah,
but
and
she wants to stay there.
And I think that's an important factor, and I think some people miss that because I talk to people all the time in these situations. Now, a lot of times if somebody's going through a loan mod or a mortgage, I can't necessarily help them get a new mortgage. But once again, it's back to that education piece. I always want to be as helpful as I can to people, and I run into these situations quite a bit. And I think that's an extremely important point. If you're in a house, let's say you've got currently a 3.5, 3-bedroom, 2.5 bath house, or a 4-bedroom, 3-bath home. Can you go and rent a similar property and replace that? If you're okay with going to a 2-bedroom apartment, that's one thing. But I've definitely seen people in that situation where they've got the opportunity to maybe do a loan mod and get the payment down to a point where it's lower than the market rents. Stay.
The only other consideration that I take into effect is long-term plan. Like I said, if I've got kids that are getting ready to graduate and go to college and I do want to downsize, well, all I'm doing is kicking the can down the road.
Right.
Versus the other way that I describe it to clients, if they come into my office and they say, listen, they're gonna bury me in the backyard.
Mm-hmm.
They're gonna wheel me out of here on a stretcher one day. Well, then let's modify the loan. You have a long-term plan to stay there. Let's modify and try to stay there. If it's a short-term plan to be there, then you're probably better off with a short sale. And then I know we're going to get into at some point, one of the factors that comes in is credit. What's the impact going to be on credit with all these various options? And so that factors into the analysis as well. But when I meet with a client, one of the first questions out of my mouth after I get some of the background facts and some of the circumstances is, well, what do you want to do? You want to stay there? We got ABC. You want to leave? We got ABC.
Goes back to that education piece, right?
Yeah.
You're not making the decision for the consumer. You're giving them options, and you're going to help them make that decision.
Yeah.
One of the things we talked about yesterday is the Mortgage Debt Relief Act, and I know it really comes into play when we start talking about short sales. Because what happens when you do a short sale, if you're not aware of this, let's say you do, in that scenario, go $50,000 short. You're going to get a 1099 from that lender at the end of the year saying that, okay, we basically gave you $50,000. Now you have to pay tax on that.
Right.
So you've got an income tax situation, but there's the Mortgage Debt Relief Act.
So it's called forgiveness of debt income, or phantom income is what people call it. And the way that I describe it, very much the way you described it. So you have a $150,000 house, you sell it for $100,000, you got this $50,000 deficit. The bank says, forget it, we don't want it. $50,000 waived. The IRS pops up and says, well, then you got a benefit because that's $50,000 that you are legally, contractually obligated to pay back, and now you don't have to.
Right.
So you got a benefit. Anytime there's a benefit, Uncle Sam wants his cut.
Sure.
So you get the 1099. Back when we were going through this mortgage crisis, there was the Mortgage Debt Relief Act. And I was trying to remember the history of it this morning. I believe it first sunsetted, meaning ended, in 2012. And then in sort of the beginning of 2013, the U.S. Congress said, we're still in the middle of this mess. Let's extend it for all of 2013. And then 2014 came, and Congress again said, let's extend it. Problem is, Congress didn't say let's extend it until the last 2 weeks of 2014. So I joke it was a law that was in place for 2 weeks.
Right.
Although it covered any short sale that occurred in 2014.
Right. Which you don't get that 1099 till the beginning of the next year anyway.
Right.
Just like everybody's getting their W-2s and 1099s right now from their employer.
Right. So now we get into 2015, and again, the Mortgage Debt Relief Act expired, sunsetted, December 31 of 2014. So we're advising people on all these short sales, telling them, I don't know what the tax consequences are going to be. Well, just the last week or two of December of 2015, the U.S. Congress extended it again. This time they extended it through the end of 2016.
Right.
And so now we know any short sale that occurred in 2015, any short sale that occurs in 2016, or any house that was lost to foreclosure in 2015 or 16, there would be no tax consequences. A lot of people misinterpret and say, I'm not going to get the 1099. That's false.
Right.
1099 is what the bank uses to report the income. It's actually Form 982 that the taxpayer would then send in to say I don't owe any tax on this money.
I would recommend hiring a good
Yes.
accountant. If you do your own taxes, more power to you. I have a CPA that does my taxes, and I would recommend if you're in that situation, that might be 1 year that you want to go talk to your CPA. And we're coming up against a break here in just a minute, and we're going to talk more about the other subjects. But one thing to remember with that Mortgage Debt Relief Act, it's really set for owner-occupied residences. If it's an investment property, you could still potentially have a tax liability.
Correct.
But I have seen situations, and I've had this conversation with my CPA, who's a very good CPA, and there is a way, if you have basically no money, that you can still, even on an investment property, eliminate those tax consequences. I'm not a CPA. I don't pretend to be CPA, and I don't know the exact verbiage. But, if you need a CPA, I have a great one. He's also in our business complex. The guy's name's Felix Blanco. He's phenomenal. I'm happy to refer him to you. Just give me a call at the office at 813-517-0795, or you can always find us at tampabay.emmloans.com. We're about to head to a break, but when we come back, we're going to continue the conversation with Shawn, and we'll go from there.
And now, back to the eMortgage Management Hour and your host, Scott Pendleton.
Welcome back to the show. If you were paying attention, we were talking a little bit about the Mortgage Debt Relief Act with Shawn Yesner with Yesner Law. One of the things we were discussing was the fact that you will get a 1099 if you have a short sale or foreclosure, something along those lines, where there's a reduction in the sale price on a property. With the Mortgage Debt Relief Act, if you own the property as your owner-occupied residence, basically it says you won't have a tax consequence. I definitely recommend, if you are the type of person that does your own taxes, this is a year. If you had a short sale this year, or foreclosure, something along those lines, or a bankruptcy, it's probably a good year to go, you know what, I'm going to hire an accountant this year to do this for me and make sure it's done correctly. So personally, I don't do my own taxes. I let somebody handle that for me. Goes back to my mentality. I want to have a professional that does taxes every day, doing my taxes, to make sure I get every benefit. I don't want one extra penny of my earnings to go to Uncle Sam in the government if I can help it. So, with that being said, we talked a little bit about short sales. We talked a little bit about loan mods. So, Shawn, tell me, I know if somebody doesn't have those options, the next option typically is, if they haven't been paying their mortgage over a period of time, we start talking about that foreclosure, right, or the potential for a deed in lieu. So kind of give me a little bit of what's the difference between a deed in lieu versus a foreclosure, and kind of take me through that process.
Yeah. So the big difference between a foreclosure and a deed in lieu, one is voluntary, one is involuntary. The deed in lieu is voluntary. I'm giving my house back to the bank, and in exchange they're waiving the debt. The foreclosure is involuntary. Right. The bank and the bank's attorneys are pushing it, and we fight it or not.
Right.
The biggest difference, which we can get into in a little bit, in my mind, is the impact that all of these options may have on credit. But putting that aside for 1 minute, the way that a foreclosure in Florida is still judicial. Florida is still a judicial state. What that means is that every foreclosure has to go through the court system and through the judge, versus a non-judicial state where it's really just a statutory document process. And as easy as, theoretically, when a car lender comes and hooks up the car in the middle of the night. Same kind of process in a non-judicial state. We're a judicial state. So we still have timelines under Florida law. There's once you're served, someone is served with a foreclosure lawsuit, they have 20 days to file a response. There's then a procedure in Florida now for them to mediate. Now, the purpose of the mediation is to determine if a loan modification is appropriate, possibly a second bite at that loan modification possibility. After the mediation either does not result in a modification, or the homeowner, the borrower, chooses not to go that route, the bank then has to produce all of their evidence, have a hearing in front of the judge, get their foreclosure judgment. That's where all the robo-signing stuff came in years ago. Was banks? It wasn't necessarily that the documentation was wrong. It was more the authenticity of the evidence. It was more the reliability of the evidence that the robo-signing impacted. But that's where all of that comes into play. The judge then grants the foreclosure judgment, and then schedules a foreclosure sale under Florida law roughly 30 days from the hearing date. So if you were to add all those time frames together, for someone who says, I'm just going to bury my head in the sand, I'm going to ignore this foreclosure and hope it goes away, the fastest the bank is going to go is 6, 7, 8 months, give or take. I know that when I was doing this on the bank side, my fastest was 97 days from the time it was filed till the time there was a sale.
Wow.
But that was early 2000s.
Different time.
It's a different time. Today, you're probably looking at anywhere 6 to 8 months if you do nothing. What a good attorney can do, what my office does, we make the bank prove up their case, and at the same time, we create as much delay so that we can get to the end goal. We're not delaying for the sake of delay. We're delaying so that we can negotiate the modification, delaying so we can negotiate the short sale. So we can ask for an extension of time to respond to certain documents. We can, taking a borrower through the modification process, build some time into the process. We can go to that judgment hearing, and typically we can get a foreclosure sale that is 60, 90, 120 days, 2, 3, 4 months from the date of the hearing. So my average in defending a foreclosure is still on the other side of a year.
Okay.
While we're working the client towards that goal. The Florida bars could get mad at me if I say I delay for the sake of delay. So we're always pushing towards that goal.
Right. And you know, when you start looking at this, you know, most people that own a home today that either have or are going through the unfortunate situation that, you know, a lot of our population has gone through with the housing bubble burst that we saw, and you're looking at a potential short sale or foreclosure. From my perspective, from a lending perspective, I look at a short sale much, much differently than I do a foreclosure. Mm-hmm. And it's not really me. It's just lending guidelines in general.
Right.
So, you know, it's important for the consumer to understand you need to work with an attorney like Shawn that has a means to an ends. He's not just waving and pushing off a foreclosure. He's really working to either get you into a loan modification if you want to stay in the house, or you're much better off doing a short sale over foreclosure, just for simple, just so you kind of know some simple guidelines. For a regular conventional guideline loan, Fannie Mae loan, if you've had a short sale, you've got to wait a minimum of 4 years before you can purchase another property and get a new mortgage. That's the wait period. For a foreclosure, it's 7 years. So it's a 3-year add-on time-wise if you've had a foreclosure over a short sale. With FHA financing, it's really it's with extenuating circumstances, and they've got to be real extenuating circumstances, a dip in pay, somebody passes away. Unfortunately, divorce is not considered an extenuating circumstance. Okay. That's just common everyday occurrence, right. Unfortunately. With an FHA loan, it's still typically 3 years, but you could reduce that down to as low as 12 months.
Well, and remember, if we're trying to get a short sale or get a loan modification, we've got to send a hardship letter to the bank.
Right.
And in that hardship letter, we have to describe what happened. Now, divorce we can use as a hardship for getting a short sale or a loan mod.
Right.
But those other things come into play as well. Death of a spouse, loss of income, increase in expenses.
Yeah.
You know, interestingly, I was talking to a mortgage company, I think someone from either Chase or Freddie Mac, when the bubble was first bursting. And I said, well, what if I live in a 2-bedroom house? What if my wife gets pregnant with quadruplets? Bank said, that's not a hardship. I said, seriously, no, not. But some of those other things. So when we're trying to prove these extenuating circumstances to the VA to get new loans, you're going to have a hardship letter. Your borrower should have that hardship letter from their short sale that they can also use for those same purposes.
You know, the moral of the story there is, you know, it goes back to, you know, working with somebody that has a plan. So where you're working through the process, and we've kind of made that determination. The person is either you're working through, we're trying to get that short sale, we're trying to get that loan mod. Maybe it just, for whatever reason, we can't get it to come together.
Yeah, it's not working. So we'll switch gears and we'll talk about a deed in lieu. And it's called a deed in lieu of foreclosure. Instead of a foreclosure, we're going to deed the property back to the bank. Their first requirement is going to be that it be listed for sale with no activity. Listed for sale at fair market value with no activity. So if your house is $100,000 in value, they're not going to accept it that you listed at $200,000 and had no activity. They're going to want it listed in the $100,000 range. If we can show that there's been no activity, no one's looked at it, no one's offered on it, nothing, then we can apply to the bank and ask them to take it back in lieu of foreclosure, voluntarily give it back to them.
Which means they have a lot less court costs.
Right.
They're happier.
No eviction costs, because one of the things they're going to require is that you give it back in what they call broom swept condition.
Right.
So their cleanup costs are going to be lower.
And sometimes banks will even pay you to do that.
Cash for keys. If you give them the property back in good shape, they'll give you, most I've seen is about $2,500 to $3,000. It's typically $1,000, $1,500. They'll give you that money to move out.
Could be enough for you to put a deposit and first month's rent down on a rental.
Moving costs. Yeah. So they'll do that. But we still have to go through the short sale process first to show that no one else is interested. Where the deed in lieu becomes an option, goes back more into your court, it's always been my understanding that the credit will continue to report that the mortgage payments are late even after the deed in lieu is completed until the bank sells the property. So if we deed the house back to the bank in January in a deed in lieu and the bank doesn't sell the house, resell the house until sometime in October, that homeowner, that borrower now has 10 more months of derogatory late pays, no pays, whatever.
That 4 year or 7 years starts from the date of the foreclosure sale.
Right.
There are some exceptions to that rule, one of them being bankruptcy. We'll get to that in a minute. But talk to us, and I'll explain that, but talk to us a little bit about the deed in lieu. Maybe the person's just really angry at the bank, and they just said, no way, they're going to have to drag me out of this house.
Right.
Foreclosure.
Well, if that's the case, then again, it's just the process. It's the process of the bank is going to convey all the evidence to the judge, and at some point, all of these other defenses are great, and I've seen them all used and probably even used them on occasion. But at the end of the day, where the judge is really going to be interested, did you make your payments? If you didn't, why? The homeowner may have a fantastic reason, an understandable reason, a perfectly reasonable explanation for why payments weren't made. But a lot of those reasons, a lot of those explanations don't rise to the level of a legal defense.
Right.
So all these attorneys, in my opinion, all these attorneys who are kicking out these foreclosures on technicalities, beating foreclosures on a technicality, they're not curing that the payment is actually in default. And so the bank's going to come back eventually.
Yeah.
And eventually the homeowner's not going to be able to prove that they did make their payments, and they're going to lose.
Sure.
And so the bank forecloses. From the day of the foreclosure sale, there's 10 days before the bank, the clerk of the court, issues title to the bank. So roughly 10 days after the foreclosure sale is when the bank or third-party bidder, whoever it is, will be issued title to the house. At that point, they can start an eviction. In an eviction proceeding following a foreclosure, there is no 3-day notice requirement. There are none of those landlord-tenant requirements. The bank files an affidavit with the court. The court grants the writ of possession. It goes to the sheriff. It can be a very quick process. The important thing that I try to impress upon clients and people that come to see me is that the day you're served with the foreclosure, you don't have to be out the next day. If you don't do anything about it, yes, eventually the sheriff is going to come post a 24-hour notice, and you got 24 hours to get your stuff and get out. And if you don't, I've literally seen them take all the person's possessions and move it to the curb. And whatever you're able to get out of there before it's either stolen or picked up by the trash collectors.
Yeah.
And I have seen it get that ugly before.
That's sad.
So
it's sad. So, when we talk about this process, here's one thing that I want to kind of impress on people as well. We do have loan programs to actually work with people even one day out of a bankruptcy or foreclosure or short sale. Now, it does require that person has a substantial down payment, typically 20% down, but there are some loan programs out there that will accommodate those situations. Sometimes it's just the right financial decision to let a property go. If you buy a house, if you bought the house at the top of the market, maybe you saw an economic downturn because of a job loss, which unfortunately a lot of people did. Maybe when the housing bubble burst, you worked in the real estate and mortgage industry like my wife and I, and you saw a huge financial downturn. And now things are getting better. We've got an improved market. Employment numbers are getting better. The economy's come not full circle, but it's doing better. It's we've seen an improved economy, and you've been able to save up some money. Hopefully, because you haven't made a mortgage payment in the last 2 years, you saved quite a bit of money. Unfortunately, I see a lot of people that just blew that money.
Yeah.
Maybe there is a situation where you've got the down payment. And I've done in the last year, I did several loans for people in that situation where they were maybe 6 months, a year out of a short sale or foreclosure, and for various reasons, maybe they had a windfall. I had a situation with a gentleman. His father called him and said, "Hey, I'm getting old. I want to give you $150,000." He had gone through a divorce. It was messy. It was a bad situation. He didn't really qualify for a conventional or FHA loan or anything like that because of some previous what I call negative financial events like a foreclosure. And in that situation, we were still able to get into a mortgage, and he purchased a home, and he's very happy.
A lot of people that I talk to have the hurdle of wanting to do right by the bank, meaning I borrowed the money, I'm going to pay it back.
Yeah.
And I agree with that, and I respect that. Personally, in my own life.
Right.
But when I'm someone's attorney, when I'm someone's counselor, I get the advantage of having that not mean as much in my representation of them. So a lot of times people will come to me and say, well, I borrowed the money, I need to pay it back. And I get it, and I understand it, and I respect it. At the same time, Bank of America, Regions, Chase, Wells Fargo, on and on and on, don't know you as Shawn or Scott.
Just a loan number.
Your loan number 1, 2, 3, 4, 5, 6, 7.
Yeah.
And none of these banks are going to go out of business if they don't get their mortgage payment. Even in the bubble, even when things were at their worst, if I recall, default rates were still very low. 10, 11, 12%, 9%, 8%, some in that range. Mm-hmm. Which means a huge majority of mortgages were performing. These banks were not losing that much.
They're still
money.
making a lot of money.
Right.
Right.
So that's how I always interpret that. I understand. I borrowed the money. I need to pay it back.
Right.
I get it.
Well, let's talk about there is a process to help you through this, and it's called bankruptcy.
Exactly.
And if you pay any attention to the news and politics lately, one of the wealthiest men in the world that's running for president right now has used bankruptcy as a tool in his business practices in the past. And like Trump said, it was there, it was a tool, and in that business setting or that situation he was in, he used it that way. And listen, I know a lot of people that have had we've probably seen more bankruptcies in the last 10 years than we've seen in the last 50.
Yeah.
Just because of the financial crisis that we've seen. Right. So give me a little bit of insight on, if I am stuck in this, potential short sale, deed in lieu foreclosure situation, how does a bankruptcy assist me? And I'll give you, after Shawn, I'll give you kind of my perspective from a lending standpoint of where it can be helpful.
So there is no more debtor prison. No one can go to jail for being unable to pay their debts. That's what bankruptcy replaced. And what it is a mechanism where the creditors are no longer able to collect those certain debts. There's two main types of bankruptcy that we talk about for individuals. There's Chapter 7, which is liquidation. There's Chapter 13, which is reorganization.
Right.
There is also Chapter 11 that a lot of people talk about. That's more for businesses, people who don't qualify for Chapter 13, people who have high value of assets or a high amount of liabilities. So mostly what we talk about is 7 and 13. If someone is behind on a home, filing a Chapter 7 means they are giving up the home. There is no way, if you're behind on a mortgage, to file a Chapter 7 and keep the house, because the bank is going to require that their loan be current if you want to keep the house. And so the debtor is now going to have to pay a huge chunk to catch up or reinstate their mortgage. And in the bankruptcy court, the bankruptcy trustee in court is going to say, well, if you're filing bankruptcy, where'd you get this huge chunk of money to catch up your mortgage?
Right.
So if someone is filing a Chapter 7 and they're behind, then they're really doing it just to eliminate the liability and get rid of the house.
Right.
In Chapter 13, you have a choice. So Chapter 13 is a repayment plan. So if my budget supports that I can pay $300 a month to my unsecured creditors, my credit card bills, my hospital bills, the IRS, etc., then that's my payment to the trustee. Trustee's going to take in that $300 and disperse it out to all the creditors. I can choose to get rid of my house. In a Chapter 13, the loan that's owed to the bank just becomes either unsecured debt or the bank takes it back, and I make my payments to the trustee. Trustee pays my unsecured creditors. I get my discharge. I'm done. Or I could choose in a Chapter 13 to save my house, and I can do that one of two ways. Chapter 13, remember, bankruptcy is a federal court process. Foreclosure is a state court process. So I am in a totally different court system, totally different rules in bankruptcy court. Especially here in the Tampa Bay area, we've got a really good mortgage modification system that I think is better than the one in place in the state courts. So I can go to bankruptcy court, Chapter 13, and I can use the modification process again in bankruptcy court and modify my mortgage while I'm in a Chapter 13 bankruptcy.
Okay.
Or I take the amount that I'm behind. Bankruptcy is typically a 5-year, 60-month plan. So I take the amount that I'm behind, divide it by 60, pay that to my Chapter 13 trustee. So in the example I gave, I'm paying $300 to my creditors. My mortgage payment is $1,000, and I'm $6,000 behind. So $6,000 divided by 60 is $100. So $300 to my unsecured creditors, $1,000 to the mortgage, to the ongoing regular mortgage payment, $100 to catch up my $6,000 deficiency. I'm paying $1,400 a month. At the end of 5 years, my mortgage is current, my unsecured debts are gone, and I've saved my house.
And you stay in the house,
right?
So once again, it becomes a question of what's your long-term plan.
What do you want to do with the house?
Do you really want the house? Do
Right.
you want to stay in the house? Do you have a long-term plan?